Welcome to Chapter 4, arguably the most important chapter for the vast majority of students and the individual who's interested in investing. Why? Because mutual funds are investments for the masses. And the likelihood of you having a 401k or other type of employer-sponsored plan at your job is pretty darn high. 403B, 457, 401A, they go by various names, but they all basically work the same, very similarly. Most have mutual funds as their choice of investments. Now, some allow you to invest in individual stocks and bonds, and of course we're going to deal with those as we go along in the semester, but no, mutual funds are the investments for the masses. So let's get started. Slide number 2. What is a mutual fund? Well, as we cursorily went through, discussed in Chapter 1 when we did our overview of investment universe, a mutual fund is an investment company that invests its shareholders' money in a diversified portfolio of securities. Investment company is the legal term, but you won't hear that unless you work in the industry. Most of the time you're going to hear the term mutual fund. And it works, but I like investment company a whole lot better because that's much more descriptive of what the company is. You want shoes, you go to a shoe company. You want a car, you go to a car company. You want insurance, you go to an insurance company. You want investments, you go to an investment company. Don't go to an insurance company for your investments. Yeah, we'll deal with that later. And you get two wonderful things: professional money management and diversification. So those are the things I asked you to remember in Chapter 1, and I'm going to beat into your brains here in Chapter 4. Each fund has a specific objective, and there are currently almost 12,000 funds to choose. 12,000 mutual funds? What is going on here? Are there 12,000 different types of breakfast cereal? And well, it seems no. Are there 12,000 different cars? Why? Well, we'll discuss this as we go along. But it turns out that mutual funds are extremely profitable. And also the industry just experienced this tremendous growth as competition heated up in the 1980s and 90s. So we'll discuss these, but what it does is it makes it very difficult to pick a mutual fund. And by the end of Chapter 4, I hope you have a better idea of how to pick a mutual fund, but it doesn't mean it's going to be easy. No, it doesn't mean it's going to be easy. There are just so many different choices. And as we've already made quick mention, many people choose mutual funds for their retirement accounts, 401ks, 403bs, traditional IRA, Roth IRA. Why? Because it just makes sense. And there's a few other reasons, political and legal, but they just make sense for the vast majority of us. People who don't want to take Business 123, don't want to read One Up on Wall Street or a random walk down Wall Street, or eventually The Intelligent Investor, because it takes skill, time, aptitude, and motivation and dedication. So here is my all-purpose graphic that I created myself. Now, aren't you proud of it? Aren't you proud of me? Here we are, folks. We're the little people, and more of them are women because they realize they can't rely on the men, the goofballs. They saw their grandmother listen to grandpa who's told, "Oh, I'll take care of you, little lady," and never saved a dime, or if he did, he blew it in some speculative investment that his brother-in-law or somebody else told him was a good idea. And then he died, leaving her penniless. And so the younger women are saying, "No, I'm not going to do that." We little people, we give our money to the people in the top hats. Now, these are the mutual fund investors, and luckily more and more of them are women, because it turns out it's been statistically proven that women are better investors than men. Now, I'll leave you to figure out why, but it's been shown women make better investors than men. And they create a pool of money Now, I know it looks like a potato. I apologize, but it's supposed to be a pool, and there are billions of dollars in these things. So these managers have tremendous opportunity and ability to invest in a wide range of stocks. If it's a stock mutual fund, bonds, if it's a bond mutual fund, and if they invest in the short-term investments that we discussed in Chapter 1, then it's called a money market mutual fund. But usually the mutual fund disappears, and you just hear people say money market. Now, what we see up here is the beginning, just the beginning of the huge explosion of different types of funds, because a balanced fund invests in both stocks and bonds. So we're just seeing the beginning of the explosion of different types of mutual funds. We'll discuss those in detail in our third presentation for Chapter 4. But again, what are the two main reasons that people buy mutual funds, invest in mutual funds? Professional money management and diversification. Because they don't buy 10 stocks or 20 stocks. They buy 200. Or they buy 250 bonds. That way, if one company goes down the porcelain oasis, then your portfolio is bare. You can barely notice it. It's not good, but if you have 10 stocks and one stock blows up on you, that's not good at all, indeed. Slide number 4. Let's take a look at the growth of the mutual fund industry. What we saw in 1940 is that mutual funds had been around for almost a couple of decades before then, but there was no regulatory structure for them. Many states did not know what to do with these things, and so many states didn't want to deal with them. And the feds were sort of sitting, well, they're not really banks, and they're not really companies and corporations, and how do you tax them? And so it was 1940 when the Congress, the Republicans and the demagogues got together and played nice in the sandbox and created the Investment Company Act of 1940. And to this day, it has stood the test of time. It created the regulated investment company that said, look, we're investing on behalf of our investors. Don't come after us for the taxes. Go after the investors for the taxes. They're the ones who are the investors. We're just doing it on their behalf. And so it shows that when the Congress works together, they can pass legislation that stands the test of time and benefits the citizens. 30 years later, there were 350, 1980, 600, and then here comes the explosion. In the 80s and 90s, we went from 600 mutual funds to 2,000, and then from 90 to 2,000, we went from 2,000 to 9,000. Yes, the 1990s were a very explosive decade for investments and mutual funds. And since then, we've added almost 3,000 more. And all this data that we'll be using in this presentation, in a couple of slides, comes from the Investment Company Institute, ICI. That's the trade organization. It's a nonprofit, but it's on behalf of the mutual funds, which are very profitable. And it is a sip from the fire hose. I mean, they have so much data. Their annual report comes out May, June for the previous year. So the last data we have is for 2016. 11,836 to be precise. Open-end, closed-end, and ETFs. And over the next several slides, we will discuss the differences of each. In 1980, slide number 5, 5 million Americans owned funds holding about 3% of their household assets. But as of December 2016, 95 million Americans in 55.9 million households own mutual funds. Folks, that's not quite half of all U.S. households. And mutual fund assets at the end of 2016 totaled $19.2 trillion. That's 22% of household financial assets. And remember, the biggest asset in most households is their house, right? Mutual funds are now the nation's largest financial intermediary, which is a fancy word for somebody who holds on to somebody else's money, followed by the commercial banks, which are the second largest, and the life insurance companies, the third largest. Yeah, life insurance companies are often called the invisible bankers. So the industry is huge, very important to our economy, very important to many people's retirement and other financial goals. So here we have the growth of the assets. We saw the growth of the funds. Now we take a look at the assets. And we go back to 2007, and we see between 2007 and 2008 was a very difficult year, folks. It was and then the industry started bouncing back until last few years have been pretty darn good. 2015, a little bit of a pause, but look at 2013, from almost 15 to 17. $1 trillion, that's with a T, trillion. And you and I can't even begin to imagine how much money that is. Because we're just looking, we're thinking, hey, if we can get 1 million, we're okay. And then 1,000 times that is $1 billion, and then 1,000 times that is $1 trillion. And we're looking at $19 trillion. Are mutual funds important to our economy? Yes. Are they well regulated? Yes. Are they perfect? No. No. But on the whole, they've been very good to us, folks. So we're gonna emphasize the positive, but we're also gonna take a look at some of the negatives. So don't worry, we try to keep our eyes wide open, because nothing's perfect, folks. Nothing we humans have ever created is perfect. It's just the truth. It's a part of being human. Slide number 7. What are the advantages? Well, as we said, you get two wonderful things. You get diversification, whereby investors buy into a diversified portfolio of securities for the collective benefit of the individual investors. And this variety provides some safety that is difficult for an individual investor to obtain on their own. With your $50 a month that you can start with a mutual fund, you buy 25 cents of IBM, 30 cents of GE, 50 cents of Apple. You see? You can't do that individually. You just can't do it. But mutual funds can, because they have millions of investors, and they pool that money together. And then they are professionals. They are supposed to know what they're doing. They're certainly getting paid well enough. And some are very, very good. And some are not so very, very good. And so that behooves us, that's important for us, to do our research and find the best money managers that have done well over decades, in my humble opinion. And I will do my best to help you do that, but it ain't easy. And it's no guarantee for the future, is it? No, just because they've done well in the past doesn't mean that it's a guarantee they will do well in the future, but it's a pretty good indicator, especially when they've done well over decades. One of the other things about mutual funds that make them so attractive to individual investors is that you don't need a whole lot of money. $50 a month, 25 some. They'd rather not. They'd rather you do 50. And they don't want you to send them a check every month. They want you to do it automatically from your payroll, paycheck, from your checking account, savings account, because then it doesn't cost them a dime. It costs them $5-10 just to process a check. They don't want that. Send them a check for $10,000, they'll thank you very much, and they'll be very happy. But no, don't send them a check every month for $50. But automatic contribution from your checking account, from your paycheck, thank you very much. We are very happy. And then lastly, we don't talk about this too often, but this is the PETA factor, which I got from The Wealthy Barber, which is a wonderful book. It's out of date, folks. The numbers are all wrong, but the concepts are timeless, so do read it. He calls it the PETA factor. Pain in the... Oh, wonderful, yes. And mutual funds indeed have a very low PETA factor. In fact, I have a renewed appreciation after having dabbled in the wonderful world of real estate and becoming a landlord. I have a renewed appreciation for how easy mutual funds are, folks. The hard part is deciding which one you're going to have, or which ones. You do a little diversification amongst mutual funds, which are already diversified. But once you have chosen your mutual fund, there's nothing more for you to do. Just, monitor it every 6 months, a year, assuming you've chosen something long-term oriented with a good history of good years, doing well in good years and bad years. Yeah, that's the cool thing. Another cool thing about mutual funds. Now, okay, we talked about the good things. What about the bad? What are some of the drawbacks of mutual funds? Well, dear students, nothing's perfect, as we said, right? There are transaction costs. Some mutual funds will charge you sales fees, either a front-end load, a back-end load, an additional load, as the Securities and Exchange Commission wants the companies to call them, that is charged every year. So they sort of sneak in the sales charge. Many others are no-load funds, but you have to be careful. Some no-load funds can wind up costing you more than mutual funds that do charge you a load, a sales commission. And why is that? Because of the annual operating expenses. This is far more important, in my humble opinion, than the sales charge. Why? Because the annual operating expenses you pay annually. You pay them every year. And they typically range from 0.5%, meaning 50 cents for every $100 you have invested, to 2% or more, 2.5%, $2.50 for every $100 you have invested. And in our second presentation, we're going to spend a lot of time, folks, discussing fees, because you are going to be the expert for your friends and family and coworkers, and you need to understand this. So when that big jerk in the three-piece suit tells you how wonderful the mutual funds in your 401k are, you can drill down and look at what the expenses are, and you can say, what's going on here? Why are you charging us so much? Because they get a kickback. Many mutual funds do not match the market's performance. Wait a minute, Piano, you told me these people are professionals. Aren't the mutual fund managers supposed to know what they're doing? Well, as we said, some are very, very good, others not so good. It's true of any endeavor. Some people are very good at what they do, and others are not so good. So we're going to do our best to help you discern between mutual funds that have been around for decades, have done well and good, and more importantly, bad times, and mutual funds that have not done that well over the long term. Cool? Okay. Now, we're going to spend some time discussing the difference between open-end and closed-end funds. And you, as a student in Business 123, Introduction to Investments, really should understand this. But the reality is, open-end funds are much more popular than closed-end funds. Closed-end funds are sort of disappearing, and there's a reason for that as we'll continue through this presentation. But open-end funds are the majority of funds. Greater than 80% of mutual funds are open-end. This is a type of investment company in which investors buy shares from and sell them back to the mutual fund. There's no limit on the number of shares. They can be issued and then redeemed by the investment company at the request of investors at any time. Investors can buy shares, purchase, and sell shares, redeem from the investment company anytime. So that's why it's called open-end. If a ton of new money comes in, they just issue new shares of the mutual fund. If a ton of money is redeemed, if the investors say, give us our money, they destroy those shares. They redeem those shares. So when people refer to mutual funds, they are almost exclusively referring to an open-end mutual fund, unless they say, oh, this is a closed-end fund, or this is an ETF, which we'll discuss in a bit, exchange-traded fund. And as of December 2016, there were 9,500 of these puppies out there, totaling $16.3 trillion in assets. All right, so this is the big group out there. Closed-end mutual funds, as we said, are much smaller, and in recent years, they are shrinking. They are less than 5% of mutual funds. They operate with a fixed number of shares. That's why it's called closed-end. Once the shares are organized and the shares are sold to the general public, you then need to buy them from another investor. So they are bought and sold on the open market. They're bought and sold on the exchanges, just like stocks and bonds are. So you incur brokerage commissions. Closed-end investment companies are not as popular with individual investors as open-end investment companies. At the end of 2016, there were only 530 closed-end mutual funds holding only $262 billion. So you see, the open end, there were 9,500 holding $16.3 trillion. That's $1,630 billion. Whereas in recent years, the number of closed-end funds are falling, and now there's only $262 billion in assets. So it's, did I say that right? 16.3 trillion is 16,300 billion, right, as opposed to 262 billion in the closed-end funds. So closed-end funds are shrinking, yes. Now, the net asset value, what is this? Well, the book goes into how to calculate it. I don't care that you know how to calculate it. You just look it up on the internet or look it up on the mutual fund website. But this is the value of one share in a particular mutual fund. And how do they calculate it? Well, they add up the value of the securities, the stocks or the bonds or whatever the mutual fund is investing in. They subtract any liabilities, in other words, what bills that you have to pay. That's normally very close to zero. And then divide by the number of shares. Open-end mutual funds are always sold at net asset value, and if there's a sales charge, they add the sales charge. But since closed-end mutual funds are bought and sold on the open market, their price usually either reflects a premium or a discount to the net asset value, often a discount. They're very rarely priced at the net asset value. Now, they don't get very far away from this net asset value, maybe 25, 50 cents, depending on how much the price, the net asset value is. But still, because of the market forces, because of the fact that they're bought and sold on the exchanges, as like a stock is, they don't necessarily sell at what the company is actually worth. And that's okay. It's just that's the market at work. So here's the formula as written out on slide number 12. You take the value of the fund's portfolio every day at the end of market at 4 p.m. Eastern Standard Time, 1 o'clock our time in California. And they go in a room, and I've read about some of these people, and it's a stressful job. They have to find the prices on all their investments. And nowadays, with telecommunications instantaneous, I'm sure it's a lot easier. But they have to calculate the value of the fund's portfolio, subtract out any bills that they have, liabilities and the like, but it's usually pretty small, and then divide by the number of shares. So this calculation, again, I'm not going to ask you to do this. The book asks you, I don't care. Maybe it's the value of the portfolio is $10,050,000, and there's $50,000 in liabilities. They have to pay out $50,000, and there's 1 million shares. So you take 10,050,000 minus 50,000. Well, that's easy. That's 10 million. Divided by 1 million shares gives you a $10 net asset value. And then if the fund has a sales commission, 3, 4, 5%, if you are buying a sales load fund, a load fund, then you would add 5%. $10 times 5% is 50 cents, and we'd have an offering price of $10.50. Again, you don't have to do those calculations. They're done for you. So now, what are the advantages and what are the disadvantages of open-end versus closed-end funds? Well, the open-end funds are always available to buy and sell. There's no market forces. You want to buy so many shares, they'll sell them to you. You want to redeem your shares, sell your shares, they'll buy them from you. They basically destroy those shares. So it's very popular. Open-end funds, there's a wide range of choices, too wide in my humble opinion. But here's the problem. Not for the investor, But for the mutual fund, say you are a mutual fund and you've done very, very well, an open-end mutual fund. All of a sudden, now money starts pouring in. So you have to go out there and put that money to work. And you've already, just figured that these are my favorite companies. I could buy more shares. I guess I can buy more shares of these companies. But trying to find more and better investment alternatives can be difficult. Plus, what happens if all of a sudden people start pulling money out of it? You were somehow painted with some terrible brush about how horrible you are, or maybe you as a mutual fund company have not done well that one year, and people start pulling money out. Now you have to sell investments that you may not want to sell to raise the cash to pay off the investors. So an open-end fund can be, not usually, but can be more difficult to manage than a closed-end fund. Mutual fund companies that have received tremendous numbers of dollars coming in will sometimes close the fund to new investors. They'll say, look, we have enough money, we don't want any more, because then it makes it hard to manage the fund. Other companies do it a little differently. What they'll do is they'll say, okay, we've got a ton of money, and we have this manager here or these managers. We'll just add more managers and basically create mutual funds within the mutual funds. And so that's the way they do it. And some have been very successful doing that. Now, what about the closed-end mutual funds? What are the advantages and disadvantages? Well, the disadvantage is you have to pay the broker's commission, but they've gotten cheaper in the past few years. But still, you have to pay a broker's commission. You have to go out and find somebody who's willing to sell their shares or buy their shares from you. And with most closed-end funds, it's not a big deal. But as we said, they're not that popular anymore, so the marketplace for them is getting smaller and smaller. They're often sold at a premium or discount to NAV. It's not really an advantage or disadvantage. That's just a truism. But here's an advantage. This is an advantage of closed-end funds. Once the manager has sold all the shares to the general public, the management doesn't have to worry about redemptions or purchases. They don't have to worry about big gobs of money coming in or coming out. They can manage the assets without any undue influences on them. Again, that's not an issue for the investor. That's an issue for the mutual fund company. And so which would you prefer? Well, you'll find that most people just go with open-end mutual funds because that's what's sold to them. And you'll find that people who are, shall we say, more sophisticated investors, more involved investors, they've taken BUS123 already and read all the good books, and they may do their research and find that this closed-end fund is something they're interested in, and they buy them through their broker. So, cool. All right. Slide number 14. We now have a new type of mutual fund. Well, it's about, 20-some years old now, 25 years old. These are called ETFs, exchange-traded funds, and they're approximately about 15% of the mutual fund universe. They're an open-end mutual fund in that there's no limit to the number of shares. Shares are issued and redeemed just like an open-end mutual fund, but they trade on the stock exchanges like closed-end mutual funds. So they're a hybrid. They're open-ended in that their number of shares is infinite. As many people put more money in, they'll create more shares. People take money out, they'll delete the shares. But they trade not through the mutual fund company, but through your brokerage firm. So the investor must now purchase the fund using a brokerage account, which incurs the brokerage commissions. But some of the mutual fund companies, most notably Fidelity and Vanguard, have opened up their own brokerage firms. And if you purchase their ETFs through their brokerage firm, they will waive the commission. They will forego the commission. Very smart marketing. Yeah, I think that was Fidelity that did that. Now, I'm pretty sure Vanguard does it too. So a recent entry to the industry, ETFs are becoming very, very popular, and their growth is phenomenal. And we'll discuss some of the reasons why later on. So you need to take a look at these ETFs. Remember, they're a hybrid. They're open-end in that there's no limit on the number of shares, but they're closed-end in that you buy and sell them through the exchanges, through your brokerage firm. And look at the growth. Back in 2006, 359, 2007, 629, 2000. Look what happened in 2008. Even though we added another 100 ETFs, boom, 2008 was a very tough year. And money keeps pouring into these things. Look, 800, almost 800 billion. In 2011, they reached over 1,000, and they reached over $1 trillion. And as of 2016, we're looking at $2.5 billion. I'm sorry, 2,500 billion. That's $2.5 trillion. Right. So when I said they reached over $1 billion here, I apologize. They reached over $1 trillion here. Did I say that? I don't remember. But 1,000 billion is $1 trillion. So the ETFs, the amount of money pouring into ETFs is continuing apace, and the industry is the open-end industry. People say it's the death of the open. They're not dying. The open-end industry is not dying, but they're definitely losing market share to the ETFs. So they're still much small. ETFs are still much smaller, but they're growing much faster than the other two. As we said, the closed end is disappearing, and the open end is not. It's not going to disappear, folks, but it's definitely losing market share. But I think it's about 200 billion a year. So at 16.3 trillion. Remember, so it's not like they're going to disappear anytime soon. Some people will tell you that, but they're wrong. Okay, slide number 16. How are mutual funds regulated? This is important. This is important because we take it for granted that the mutual fund industry is well regulated and fairly safe, and that there's not going to be any hanky-panky going on. But why? How did it come about? It just didn't happen in a vacuum. Well, as we said, the politicians worked together back in 1940 to create the Investment Company Act of 1940. That was the foundation of the modern mutual fund industry. Before that, these things existed, but the regulators, the IRS, the bank regulators, and the securities regulators what are these darn things? What's going on here? Because when a company makes money, the IRS says, hey, you owe us taxes. And the mutual fund said, no, you don't understand. We aren't making the money. We're making the money on behalf of our investors. Go after them. And, okay, we can work this out. And so the Investment Company Act of 1940 defined the regulated investment company, which is a pass-through investment vehicle. You don't pay the taxes, mutual fund company. We don't pay the taxes. Our shareholders pay the taxes because we invested on their behalf. Now, of course, the mutual fund company is making money, but that's through the fees that they charge the investors, and of course they pay taxes on that. To qualify to be an investment company, the investment company must hold all of its assets as investments in stocks, bonds, and other traditional securities, and have a very limited ability to use derivatives and other risky strategies. So what are those derivatives and other risky strategies? Well, we already mentioned in Chapter 1 that those things are just toxic, dangerous. Yeah, you can make a lot of money, but more likely you're going to lose a lot of money quickly. Overnight, boom, gone. So the mutual fund companies have very limited. They have some ability to use certain derivatives, but very little. So in other words, we want you to invest in stocks, bonds, and other traditional securities that have stood the test of time. Now, that doesn't mean you're going to do really, really well, but at least you won't vaporize the portfolio overnight. And they must use no more than 5% of their assets when acquiring a particular security. Now, what does that mean? Well, if you have 100% and you divide that by 5%, that gives you 20. It means you must invest in at least 20 different securities. So if it's a stock fund, you must have at least 20 stocks. If it's a bond fund, you must have at least 20 bonds. Now, as we said, it's typical for them to have 150 or 200. Some will have 40 or 50. Those are very concentrated mutual funds. maybe they'll do very well, maybe they won't do very, very well. But others mostly will have 150, 200 different securities. And that way, if one disappears, one company goes Enron or Kodak or whatever, then the other 199 will hold up the portfolio. And they must create an organization with checks and balances. Now, what does that mean? If you've taken your civics class, your political science class, and United States history, you know that that's the idea in any powerful organization. We're supposed to have entities that check the power of the other entity and balance out the power so that no one faction becomes all powerful. Boy, there's a lesson in there. And anyway, slide number 17. This is the organization that the mutual funds have to create. Now, I would have turned the thing upside down. This is from your book. I would have put the shareholders as the base of the pyramid, but they have a top-down, whatever. The shareholders have the board of directors as their watchdog. Their job is to oversee the fund's activity, approval of the contract with the management company that actually makes the decisions, other certain providers who contracts usually represent the majority of fees paid by the shareholders. In other words, they're your watchdog. And 75% of them must be independent, not work for the mutual fund company. And in the past, some of these boards of directors have been accused of being basically rubber stamps and not watching out for the shareholders' best interest. And there's some truth to that. But in reality, folks, as a board of director, you don't work full-time as a board of directors. It's a part-time position. It's a very prestigious job, but you're not watching what's going on all the time. So you really do have to find an investment advisor, a management company, a distributor, a transfer agent, a custodian, all the different entities. You must find reputable, qualified people who you believe will give their best efforts and put the interest of the shareholders above their own interests. And sometimes it's not easy to do. It's not easy to do. So they do their best in most cases. There have been some very few, but very notorious exceptions, but that's the exception, a very rare exception, not the norm. And then you have the mutual fund itself. Now, I don't know why they put this thing here. This thing, it just says mutual fund. If you're listening to this, you'll know what I'm talking about. But if you're watching it, you see this box called the mutual fund. I would have put this box all around the other boxes because that's what makes up the mutual fund. And by far the most important entity in the mutual fund is the investment advisor, the management company. Why? Because these are the people who are going out into the world and knocking on the doors of GM and Ford and Honda and Toyota and Chrysler and doing the research and deciding, yes, we do want to buy GM. No, we don't want to buy Ford or AT&T, Verizon, T-Mobile, Sprint. See, these are the people who are making the decisions about what investments are going to go into the mutual fund. And it's not easy to do. It's not easy to do because you have to basically think about the future. If you're doing it right, then it's not cheap because you need good people and they need to go all around the world because the world is global now. And we'll discuss this later on as we learn how to choose individual stocks and bonds. You'll see that it's not an easy job. The distributor is the entity that actually goes out and sells the shares to the public or through other brokers. The transfer agent, I'm sort of skipping custodian right now, I'm independent public accountant. The transfer agent is the entity that actually processes the orders. The orders to buy coming in, the orders to sell, the money coming out. And then the custodian is the entity that actually holds on to the assets. You see, the investment advisor, the management company, they don't touch the stocks. They just simply say, this is the stock we want you to buy, and then the custodian is the one that holds on to them. Now, they obviously have some trading group that takes care of that. They don't put that here, but the custodian is the actual company that holds on to the funds. And then the independent public accountant is the group that makes sure everybody's doing what they're supposed to be doing. You say you have 100,000 shares of Microsoft. Okay, where are they? Okay, custodian, here they are. Custodian says, here they are in this brokerage firm on this company here. Okay, cool. And they go through and every year certify that what has happened has happened. What they say has happened has happened. That's the job of the independent public accountant. And you might have heard of Price, Waterhouse, Cooper, Deloitte, and Touche, which I now think is called just Deloitte, KPMG. Maybe you've heard of Arthur Andersen. Yes, they were they were the independent public accountants who were allowing Enron, this is about 15 years ago now, to cook the books. Well, they're gone. Arthur Andersen is gone, but these are the big public accountant firms. So you understand what's going on? These groups check and balance one another to make sure that there's no hanky-panky. Slides 18 and 19 now are just what we just discussed on slide 17. The mutual fund is the corporation run by the board of directors on behalf of the shareholders. The investment company have the investment advisor is the management company that makes the decisions. Portfolio managers, sometimes a team or a committee, they make the decisions about what stocks or bonds to buy, and then they have teams and entire groups of research analysts who go out there and knock on the doors and bring back the information. The distributor distributes the shares to the public. Mutual funds are technically continuous initial public offerings. Now, what does that mean? Hang on, wait till we get to chapter 5. They are always being sold anew and they are always being destroyed, so they must have an annual prospectus, an annual report, and you don't have to worry about that. Read about it in the book if you're so inclined. We'll discuss initial public offerings in detail in chapter 5. Because mutual funds are continually sold and redeemed, they are considered an initial public offering. Continuously. They're always being brought to the public. And then slide 19, the custodian is the company that actually holds the securities. Often this is a bank or a trust company. In fact, there are certain trust companies and banks, that's all they do. They don't work for any one particular mutual fund. They just say, look, we will be your custodian. So that's one of the reasons it's so easy to start a mutual fund, because you can hire all these services, and all you have to do is find somebody who's very good at picking stocks or picking bonds. Very, very amazing. The industry is huge, folks, and there's a spot for you in the industry if you're so inclined. The transfer agent, as we said, keeps track of the purchase and redemption requests from the shareholders. So a shareholder sends in a check for $10,000. The transfer agent takes care of that. If they ask for their $5,000, they take care of that. And then the independent public accounting firm, as we said, makes sure that there's that what they said is happening is actually happening. We have to do an audit and make sure that everything is cool. So we ask ourselves, why the large diversification of tasks in companies? Well, mutual funds are highly regulated in order to protect shareholders' investments from fraud and collapse. How often have you heard of a scandal at a mutual fund company? Well, in 2003, whoa, wait a minute, Payano. Did you just say mutual fund scandals? You want me to invest in an industry that is plagued with scandal? Well, yeah, as a matter of fact, I do. Since 1940, the mutual fund industry has been regulated and escaped any hint of impropriety, which is a fancy word for hanky-panky, trucos, travesores. In 2003, some practices that were not quite illegal but obviously unethical were uncovered. Folks, it was only a handful of funds, a handful of people that were doing this. At the company called Alliance, which is no longer called Alliance, there were 2 people doing this. And it tarred and feathered the entire company. They were knocked out of the top 10. They're a good mutual fund company, folks. 2 people. At Strong Funds, the leader, the guy who started it, Mr. Strong, who had built this into a powerhouse of mutual funds, he was doing it. And what were they doing? Well, it's kind of hard to describe, folks. I don't want to get into the details, but they were basically stealing hundreds of pennies from the other shareholders. How are they doing this? Well, it's I don't know. If you follow me, great. If you don't worry about it. But say you are fairly savvy and you understand how global markets work. You know that mutual funds are priced at 4 p.m. Eastern Standard Time, the time that the markets close in New York City. But you have a Japanese fund. Well, obviously, Japan is on a different time zone, 12 hours away. And after the markets close in New York, a couple hours later, the markets are going to open in Japan. And say the market in the United States tanked. It went down 2% or whatever, which is a big jump. You have a pretty good idea. Now, it's not guaranteed, but you have a pretty good idea that since the markets are global now these days, Japan is going to tank the next day. But 2 hours after New York closes, because it's the next day already in Japan. So you sell your Japanese fund on day 1. Day 2, Japan's stock market does indeed drop 2% or whatever. You buy back your Japanese fund. You see what's going on here? They were gaming the system. It wasn't illegal, but it certainly was unethical. And Mr. Strong was doing it. Now, this guy, when he did this, was worth $600 million. He made approximately $80,000 from doing this. Why? Why would you do that? You're worth $600 million. And he was barred for life from the industry, and he was very contrite. He said, look, I've destroyed my life. I have let down every person that I respect and love. I have broken their confidence, and I really was stupid. Because I guess it's that mindset. You think you're invincible. Everybody tells you how wonderful you are, and the money's flowing in. And you just do something really stupid. To you and me, $80,000 is a lot of money, but to somebody who's worth $600 million, it's pocket change. Janus, a few employees at Janus, Bank of America funds, and Putnam. Poor George Putnam. Oh my goodness. George Putnam was rolling in his grave, thinking about what happened to the mutual fund company he created. And a lot of people thought Putnam was going to disappear, but they were eventually saved. The vast majority of companies, folks, never engage in any of these shenanigans. And it's not like folks who lost everything in Enron, right? When they had $100,000 in their 401k and it was all Enron stock, and they were employees of Enron, and it just disappeared. No, you lost a penny on a $100,000 account, if you lost that. But when you have 1 million people stealing a penny from one, you see that's a lot of money. So I end on a sad note, but it's actually a happy note, because the industry, again, it was very few people, and the industry bounced back. None of this stuff is going to happen anymore. What happens now is companies they won't let you do this. They just forget it, Or if you do it, sure, we'll charge you 2%. Go ahead, buy back your fund the next day, but we'll charge you 2% and give it to your fellow shareholders. So this has been corrected. But the mutual fund company industry is, it's not perfect. Nothing's perfect. But it's pretty darn good, folks. And again, it's for the vast majority of us investors. Now, some of you're going to learn how to pick individual stocks and bonds, and you'll say, I don't want to deal with mutual funds. And why? Because of the fees. And because nothing's perfect, right? In our next presentation, we are going to learn about the fees of mutual funds. And this is very important because, as we said, you are now going to be the investment guru, the investment expert for your friends, family, coworkers, and you can't let them down. So get ready to stretch your brain in our next presentation when we go through fees. See you in our lecture number 2.